there are three ways to save the world. The first way is to put a tax if we as entities or if larger corporations emit beyond a certain number. Let's call it carbon tax. Indian government has also finally brought what is called the carbon credit trading scheme in India. The baseline numbers have already been given to the entities and it will start trading very soon.
Carbon markets are often talked about but rarely explained from first principles. This conversation matters because it looks at how carbon credits are actually created, verified, priced, and trusted, and what needs to change them to have real decarbonization effect, not just claims.
The third way to save the world is to really do some project. The 1 ton of CO2 saved or reduced by a project is equal to 1 carbon credit. Now, in a voluntary carbon market, there are three key stakeholders. One is called the project developer or supplier of the credit. The second is the buyer of the credit. The project developers could be startups, could be SMEs, could be companies purely doing it for carbon credit.
Hi, welcome to the Bottom Line podcast. Today, I'm joined by Abhimanyu Rathi, founder and CEO of RenewCred. RenewCred is building the data governance and assurance layer for high integrity carbon credits in the voluntary carbon markets with a focus on tech based real economy decarbonization project. Carbon markets are often talked about but rarely explained from first principles. This conversation matters because it looks at how carbon credits are actually created, verified, priced, and trusted, and what needs to change for them to have real decarbonization effect, not just claims. Hi, Abhimanyu. Thank you so much for joining us.
Thank you for having me here. I'm quite delighted to be part of this platform.
Thank you so much. So, before we get started, maybe a quick introduction on your part and how did you get into building RenewCred?
Thank you. So I've been in the world of science and startups for about 16 years now. I started my journey as a chemical engineer and a water scientist. I was working on alternative routes to RO machines. RO wastes 3 liters of water for every liter purified and requires energy. I built a system that doesn't waste water, doesn't require energy. From there on, I moved to working a lot in the solar space, in the renewable energy space. Worked on what are called dye-synthesized solar cells, which is conversion of e-waste into solar panels. So I've been a project developer and a scientist for a very long time. From chemical engineering, I did a degree in law, environmental law and policy, and have been building startups even before I did engineering. So I knew how money works, I knew how science works, I knew how policy works. And then I got to the other side of the table. So I became a VC, started investing into early stage social impact startups via a fund called Build 3 based out of Goa. And then 2 years ago, I had this realization that perhaps money might not change all our problems, can solve the climate problem. So how do you use money to solve the climate problem through sustainable finance and carbon credit being the language of this? So all my experience and my academics culminated into this company called RenewCred that I've been building for the last couple of years. At RenewCred, we pitch ourselves as Robin Hoods of the planet. So we take money from the rich polluters and end up investing into good climate projects. So that's what we do. Happy to dive further into it.
Yeah, happy to take you up on that, but that's quite the introduction. Thank you for that. Carbon credits and the carbon market in general tends to have multiple facets, right? And there are a lot of key players in the ecosystem involved. But for those joining us who do not understand how this market works, and of course, there is a lot of jargonization that is happening. And there are people who are giving out self-made definitions, and that tends to confuse a lot of people. So, from your side, could you please clarify to all of us what the ecosystem looks like, who are the key players, and how does the market work actually?
Amazing. So let's have a very first principles layman approach to this. There are three ways to save the world. The first way is to put a tax if we as entities or if larger corporations emit beyond a certain number. Let's call it carbon tax. So if a company has been asked by government to not emit more than say 10 tons, hypothetically 10 tons of CO2, and they do more than that, they end up paying a tax. We didn't does that. Colombia does that to some extent. The other way to do it is exchange or trade emissions. So say you and I are a company and government says please don't emit more than 10 tons. I do 11, you do 9. I can come to you, pay you some money, and ask you to put my extra 1 ton in your quota. This is called trading of emissions. And this is most general form of reducing CO2 from the atmosphere. So EU does it today, America, California Trade Commission, China does it to some extent. All of these are called emission trading schemes. Now, how does emission trading scheme really save the world? Every year, the government will make that cap much stricter. It starts, say, hypothetically with 10, then it will come to 9.5, then 9. Indian government has also finally brought what is called the carbon credit trading scheme in India. The baseline numbers have already been given to the entities, and it will start trading very soon. I mean, these two ways, the first carbon tax and the trading of emission, this government involved. Government is putting a cap, but there are no real projects that happen. So this is called a compliance mark. The third way to save the world is to really do some project. It could be setting up a forest or saving mangroves or doing solar energy or driving EV vehicles. The work done by the entity is converted into what are called carbon credits. The 1 ton of CO2 saved or reduced by a project is equal to one carbon credit. These carbon credits are bought by larger buyers. Now, why do buyers buy? Primarily for two reasons. One is regulatory reason. Second is altruistic reason. The company like Microsoft will say, I will not just reduce our current emission, I'll go back in history and reduce all the emissions we have done so far. And this happens through carbon credit, which is called offsetting. There is third and the most logical way also to do it, which is called insetting. You reduce your own emissions by external innovations. Set up solar, reduce your water usage, become zero liquid discharge company, etc., etc. That is called insetting. The problem with insetting is at some point you will not be able to do it. It will become resource inefficient or money inefficient. That is why offsetting or carbon credit is so lucrative. Now, in a voluntary carbon market, the question that you asked, there are three key stakeholders. One is called a project developer or supplier of the credit. The second is the buyer of the credit. The project developers could be startups, could be SMEs, could be companies purely doing it for carbon credit, could be companies where reciprocal revenue stream ends up being carbon credit for the nature of work, etc. On the buyer side, this could be a direct corporation, it could be a broker and trader of credit. Now, these brokers and traders don't really care about climate, but they know the money of credit is increasing, hence they want to get into this. It could be public exchanges of carbon credits also. Now, between a buyer and seller, there's one more party called technically a standard and registry. So people who are familiar with the climate world must have heard names like Vera, Gold Standard, now Isometric. These are standards and registry. A standard and registry certifies, verifies, and issues the credit. So a project developer can't directly walk to a buyer and say, I have X number of credit. They have to go through a standard and registry. The standard and registry also appoints a fourth party validator. And I call this fourth party because now we already have three parties, the buyer, seller, and the registry. The fourth party validator and verifier goes to the premise of the project developer and verifies all the claims. So when everything is said and done, X number of credits are issued, which are transacted in the market. Just recapping everything. There's a tax, there is an emission trading scheme, and there's the voluntary carbon market. This is how fundamentally a carbon market works.
Got it. Thank you so much. And I'm sure this will clarify a lot of things because people tend to often confuse offsetting to carbon credits, and
Yeah,
they're used in exchange, right? Which becomes problematic when trying to understand the market.
right.
And thank you so much for this question. But when I look at this ecosystem and when I look at this market, right? Um, I'm going to draw a parallel to finance and say that when you look at finance, there are multiple checks and balances in place.
Yeah,
Yeah. There are conflicts of interest, and there are parties acting in their interest, which make the market more competitive, so to say, right? To but here, what I notice is that there are no conflict of interest between parties. It makes sense for the project developer to to create more projects. It automatically makes sense for the standard and registry to say certify and give out more credits and approve and certify more credits, because I'm assuming there's a pay per approval. It makes sense for the fourth party validator to validate because again, pay per approval. uh, So who in this ecosystem is in picture to create that check and balance, for whom the interest is in rejecting the claim or going the other way around?
Yeah, yeah. No, that's a very important question. And actually, there are quite a lot of checks and balances in the carbon market. So my answers are now going to be pitched more towards the voluntary carbon market. In the compliance market, obviously, government is the one monitoring the movement. In the voluntary carbon market, the prerogative of monitoring conflict of interest is on the standards and registries, which themselves are private bodies. You have to think of them like ISOs of the world. That's the closest analogy that I can create. Now, this is a very important one. A project developer can't be a buyer of credit. A project developer can't be a standard and registry. A standard and registry can't be a verifier, and a verifier can't be a buyer. All these four can't play two roles, or else there will be a conflict of interest. Now, how will this happen? Project developer can't audit their own projects. An auditor can't appoint an own third party to go and verify because there's no third party, it's the same party verifying. The buyer can't play the auditor's role and say, hey, I want more credits at a lower price. So all of this can't happen. And that is why carbon credit is also called a quasi-financial instrument because of these checks and balances. So this is very well there in the place. Also, a methodology. The standard and registry does two work. One is writing the standards of what are called methodologies technically. So these are scientific algorithms against which your project is vetted. If I'm doing solar, I might have a genuinely lower number of carbon credits generated versus something doing like biochar. All these algorithms are written by the standard and registry. The standard registry also does the another work of maintaining a register. That is why it is called standard and registry. How the register? How are these credits being transacted? How are they moved? Which party bought them? What happened? And the credits also changes hands many times. It might go from project developer to broker A to broker B, finally to an entity. And how is this different? The only difference between a share market and a carbon credit market is shares are transacted in perpetuity until and unless they are redeemed or bought back by the corporation. In a carbon market, there's something called retirement. So a corporate will say, hey, I emitted 10 tons of CO2. Please retire these credits against my name. And this retirement work is also done by the registry. The registry maintains all of this. So this is why these checks and balances are completely there in there. Yeah.
Okay. No, thank you for explaining that, because again, it's hard to get these kind of insights because there isn't a lot on the net when you look at the resources to understand how the market is operating. There are
Yeah.
opinions around, but
Yeah.
it's really imperative that somebody from a key player from the industry can give us an overview of how the market is working, because I think that would really help the understanding. The next step and understanding a little bit more about the economics of it. How are the credits priced? Is it a demand supply driven pricing, as is in the case of stock market and shares, or is
Yeah.
this because from my understanding, when you price a stock, in the market, you do it on the basis of fundamentals of the company, right? Which are of course different key variables, which
Yeah.
are changed. But here, when you look at one carbon credit, the standard remains the same, right? It's 1 ton of CO2e that
Yeah.
is used or stopped or prevented or exchanged, right? So, uh, how does the pricing variance work?
Yeah. A brilliant question. And there are four things that I will speak about. So I might take a little longer on this, but it's an important one. The first one is that this is quite similar to the financial market in the sense that there are some metrics against which a project is weighted, and then it is supply and demand. In the financial market, you have PE ratios and the health of the company and their MIS. Over here, you have words like additionality, which means that was the project genuinely doing something over and beyond what it was normally meant to be, or did this advantage just happen in normal course of business? Because if it happens in normal course of business, there is no additional advantage to the climate that happened. So that's the first check. The second check is called permanence. How permanent is the project? Is it a one-time stopgap arrangement or is it going to last for a longer time? Third is leakages. I saved the project in Delhi, but did it end up doing some problem in Punjab? So these are called leakages. And I'm boiling down these definitions. Obviously, they are far more complex. And then there are many, many other things that are looked into the project from a health of the project point of view. The second thing is These projects are classified in two ways. The one is called nature-based and non-nature based. The setting of the forest, saving mangroves, ensuring the forest lasts, all of these are nature-based projects. Non-nature based is, and people have different definition. My definition is where there is a machine part involved. So EV fleet, solar energy, windmill, industrial biochar, these are machines. The problem in nature-based projects is suppose I set up a forest of 100 trees. I don't know the quality of soil. I don't know the quality of seed. And I can't put an IoT inside a tree and expect the tree to tell me how much CO2 is there. So nature-based have their hit and miss, which also leads to the fact a lot of people saying that carbon markets is greenwashing. And we'll come to that later too. Whereas in non-nature based, you get pure raw data from IoT and sensor. You know how the asset is performing, and you can relay back. The third classification is, and third way to look at carbon credits is there are three kinds of carbon credits. One is called an avoidance credit. I avoided something to something else. I drove an EV vehicle instead of a petrol vehicle. I use solar energy in case of a thermal energy. But these are not really sequestering CO2 from the atmosphere. So the analogy that is given is think of it like a bucket of water, our planet being a bucket of water, and are you removing water or are you just water being the CO2 over here? And just one quick clarification, every time I use the word CO2, I mean greenhouse gases, but it's just synonymous to CO2. That's how we talk in the carbon market. And this is an important classification because methane is 28 times as deadly as CO2. So CH4 is 28 credit. SOx
Yeah.
NOx is 256 times deadly. So
Hmm.
coming back to the classification and I was talking about, one is avoidance. The second is called reduction. What is reduction? I'm reducing my own consumption of greenhouse gases. I was using a bad 3, 4 stage boiler that was using XYZ fuel. I went to using a good boiler, 1, 2 stage boiler. So it's reduction of fuel. And the third classification is removal credits, where I'm actually removing CO2 from the atmosphere. The removal is biochar is one classic example. It's biochar is nothing agricultural waste converted into fertilizer by a process called pyrolysis. Here you are locking in CO2 into the soil for thousands of years. Another example is which the government just announced in the latest budget, carbon capture utilization and storage. 20,000 crore given by the government. It was long
The
due.
the
Yeah,
CCU, the CCU,
CCU.
yeah.
Yeah.
Okay.
CCU is another classic example of carbon removal and so important for a country like India.
Hmm.
Now, answering your question, because avoidance have the least effect on environment, their demand tends to be the lowest. And so they transact anywhere from $0.50 to up to $25. That's the range of avoidance credit. Reduction is slightly better for the climate, hence the demand is slightly higher. They transact anywhere from $10 to 75, $80. And removals, which are best for the environment, hence the demand is highest. They transact anywhere from $40 to $1,800. So depending on the nature of credit, what is the underlying work the credit is doing, plus the demand, the price is determined. And the final thing, having said all of this, price is a prerogative between the buyer and the seller. The market forces just let you know at what price point they can be sold. In the same project, a project developer might sell for $100, same kind of credits, and the same kind of credit for $10 to different buyer also. And this is where it is slightly unlike the financial markets. But this is how the market works. Yeah.
Got it. Very helpful. Thank you for this. But the intuition of it slightly, I'd like to double tap on that. The unit that we're all talking about is, I'm assuming all the stakeholders, all the players in the industry, the unit that of conversation is 1 unit of carbon credit, right?
Yeah.
And not the price.
Yeah.
When you say that these are priced separately, I'm assuming one credit is priced separately, priced differently, depending on if, like you mentioned, it's avoidance or reduction or which level of carbon credit it is, right?
Yeah.
At the end of the day, let's say my mandate or my I would say end of the year, my target is to reduce or say offset 20 credits.
Yeah.
How does it matter if I buy a credit worth $18 or $1,800 if 18 credits is my target?
For this, we need to understand what's the buyer's sentiment of even buying the credit in the first place.
Hmm.
The buyer buys it because of regulatory reasons. It could be CSRD in the Europe, it could be BRSR in India. It could be one of their subsidiaries is coming out with an IPO and they want to let the world know that they are very climate conscious companies. Lastly, it could be because they're tapping into ESG funds and investments and they want to let the ESG investors know, hey, we are climate conscious, we're not already. Over there, largely what you are saying really happens. Intuition kicks in and they are looking for the cheapest available credit. Different people put it different way, but this is the reality of the market and I don't have any hesitation calling it out. Over there, the cheapest credit goes for sale. But then there are companies that understand the market who are doing this for altruistic reasons, like I said. Companies who want to let the world know, hey, because of our project, really CO2 was removed. They want to let the world know these are the SDG goals we made, this is the employment that we provided. These are the story packages that they can relay back to the world. And the third thing also is companies are hesitant to try to enter the market because they're afraid if they buy a cheap credit and 5 years later the project itself is declared to be invalid, all of these credits also will go invalid. And that is why more and more data, and this is becoming a data game now, along with a climate game. The more the data you relay back, obviously the cost will add up for the credit, but there's more assurance than just greenwashing. So these factors play in while you determine the demand for the credit. And that is why I said that removals today are more in demand rather than avoidance and so that's the picture.
Got it. No, understood. That makes sense actually. Because I understand where that is coming from, but from your understanding, what percentage, or I think, of your key customers, or not customers per se, players in the market, are driven by just some form of greenwashing, and how many are truly actually
Yeah,
careful about the emissions that they're giving out and are doing it, say, for an altruistic reason?
yeah, yeah. So there's a body called Science Based Target Initiative, SBTI, and then there are net zero trackers and a lot of bodies doing a lot of work on this. Carbon Disclosure Project, CDP being the third one.
Hmm.
They track how companies are investing into carbon markets and what are some ways that they are really using for decarbonization. So we'll use the STBI data. 3 years ago, the number of corporates that were passed of SBTI, Science Based Target Initiative, was somewhere around 2000. Today, that number is somewhere closer to 14,000. The number of companies actually getting into carbon markets increasing. Now, why is that happening? 2015, the world signed an agreement called the Paris Agreement, and we started taking net zero goals far more seriously. In India, these net zero goals were passed on to Maharatna and Mini Ratnas. India said, hey, we will reach net zero by 2070. So Maharatnas and Mini Ratnas, and then it came to the private sector also, and most companies have announced their goals. And some are trying to be carbon neutral, some are trying to be net zero. So that is where a lot of buying into carbon markets started. The second reason for this was also that companies have a far more cleaner realization that if they don't invest now, then the future will become very grim for them. And the Gen Zs are also asking the right questions. So something good that has happened. The shirt I'm wearing is climate conscious or not? The food I'm eating is sustainable or not? And how do you relay back all of this? Tends to happen through carbon markets, both insetting and offsetting. The third reason is regulation is becoming much more stronger. And finally, India has CCTS, which is a milestone movement for India. The CCTS, what will happen is it will come to only 9 or 10 sectors. But there will be reciprocal advantage for other sectors also because they will also try to decarbonize themselves. The SMEs will try to decarbonize themselves. This will again happen through carbon markets, both compliance and voluntary. And the fourth is there is something happening at the project development side also, which is called a rights law. With increase in production, costs come down. So when I was doing solar in 2015, we were paying 70 rupees a watt. By 2020, it was 17 rupees a watt. Direct air capture came down from $1,200 a ton to about 130, $150 a ton of CO2. The rights law is playing out. All of these development are propelling the carbon market right now.
Yeah, no, and I think once the traction comes, you significantly see the ecosystem or key players around it facilitating better. But now we have specialized finance or NBFCs who are specially funding just solar projects,
Yeah,
and I think that's quite the feat to achieve, given that a sector is receiving so much attention that there are key players propping up in the sector for specific function within that sector to facilitate better energy utilization, become energy conscious. So thank you for that. I think it really, really strengthens our understanding of what is happening. Now coming back to what RenewCred does, could you give us a brief of what in the entire ecosystem, where is RenewCred lying currently, and what are your plans for the future?
Yeah. Just to answer in simple terms, we are a standard and registry, one of the earliest in India, not just in India, in the global south to do that. So this sounds very simple. The carbon market, simply pay for the projects that are saving the world, and there you go. There's no climate change, and we can all live happily ever after. But there are four big problems with this market. Number one, the registries and the verifiers tend to be super corrupt. Projects that are not even there in the first place are sanctioned. Validation is not properly done. Second, which I already touched upon, is the debate between nature and non-nature based credits. Nature-based credits are not 100% secure vis-a-vis non-nature based or engineered credits. The third problem is, in today's environment, the project developers have to pay a fee to enter the market. And this is so counterintuitive. I am the one saving the planet, I am the one paying for it. And this fee is not a small fee, it is anywhere from 10 lakh to 1 crore in INR terms. It's a hefty fee. And the fourth problem is, and this is why we are also having this discussion, nobody knows what a carbon market is. Who to go, how to get a carbon credit, what price point is credit being sold, nobody knows any of this. So what do we as a company? We do four things as a company. First is we write the science. So right now we're a network of 93 scientists spread across 5 nations, 86% PhD holders, 68% women coming back to work. We're increasing this network to up to 250 in the next 4 months by end of June. These scientists write the most rigorous methodologies. They apply Murphy law and they make sure there is no greenwashing happening. We only focus on non-nature based credits. We don't do nature based stuff right now. We will in due course of time. Right now it's just non-nature. Because we do only non-nature based, the second thing we do as a company is write the technology behind it. So we collect the IoT and sensor level data from the asset, run it across our ML models, put the algorithm into the system, and then we issue the credit. And all of this is happening in real time. So within 24 hours, truly authentic credits are issued, which the buyer can log in into a system and see how the asset is performing. The third thing we do is we enable transactions into the market. So what we have done is we have flipped the business model. We don't charge the project developer at all. It's completely free for the project developer. We as a company only make money when the credit is sold. So we have a buyer pays model. We have a certain transaction fee that we take. Why do we do that? Because we say we are 100% sure ours is the most authentic, highest quality carbon credit. So there's our skin in the game. And when the credit is sold, we'll take the money from the buyer in the transaction basically, and supplier doesn't end up paying. So we enable transactions and we have just created a marketplace. Now we're looking to create an exchange also for the transaction of the credit to happen. All credits are on a blockchain layer. We're using the algorithm blockchain to do that. And the fourth thing we are doing as a company is now we are launching a lot of education products. Like you have rightly pointed out, people don't understand the carbon market. So we're coming out with some courses and more education program, especially targeted to the chief sustainability officers and decision makers to understand what a carbon market is. So this is how we are quite different from the others right now.
And just to dive deeper into the when you're saying you help in formulating the principles, so for a principle to be widely accepted, it needs to be ratified, I'm assuming, by a certain governing body. So is there a governing body equivalent in place at a global level or at an India level
Yeah,
that ratifies these principles and makes a RenewCred approved carbon credit valuable, basically?
yeah, yeah. Fortunately or unfortunately, I don't know what to put it, but there is no ratifying body in the voluntary carbon market. The
Okay.
algorithms or the methodologies are as good as somebody pointing out, hey, there's an error in them. And this is
Mm.
why so many standard and registries coexist right now.
Mm.
De facto, there are close to about 56, 57 registries, but obviously two or three of them occupy a larger chunk of the market. What we are trying to do at RenewCred is we're also creating very India-specific methodologies. The livestock methane. India is a cattle-rich country, but cattle emit methane. Now, this methane can be reduced by a compound made by Indian Council of Agricultural Research and many others also. But how do you calculate that? Again, EV fleets. We are the first one to write a proper methodology and the technology behind it. But having said that, there are multiple organizations. One of them is called the Integrity Council of Voluntary Carbon Market, ICVCA. The second one is called Corsia. This is for aviation sector. Then there are a few others also where you can be empaneled or have a certification from, and this adds to more trust in the market. So like CAs have the CA Institute, or us chemical engineers have a chemical engineer. ICBCM also works in that way. And then they define some core principles how the market moves. And then a lot of third-party audits by independent researchers and scientists also keeps happening. So this is how things work in a voluntary carbon market. In a compliance market, obviously every country's government has some form of certification. So in India, the certification is called Accredited Carbon Verifier. So you can become a verifier within the Government of India CCTS framework, and even RenewCred is in the process of becoming an ACV. In the compliance market, we work as a verifier. In the voluntary market, we work as a standard and registry.
Got it. You act as a registry, which is again keeping tabs of who owns which credit. I'm assuming across a certain ecosystem or across a certain buyer seller
Yeah,
level. But apart from that, you also mentioned that you do verification process at least your level, which is when you certify, approve the carbon credit and allocate it a certain quality or a grade, right?
yeah,
And that grade is allocated basis certain data that is evaluated using the ML models that you've or methodologies that you've built.
yeah.
Right. So now the data that is coming from various IoT sensors, etc. Is there another third party company that just does the data part, which is the sensor which is setting the sensor level data at various projects and then collecting real time data from those projects, or is that you, or
Yeah.
do you do that process as well?
So one correction, and then I will come to the process. Why we do the verification itself is done by a third party. So we write the science, we write the technology behind it. But is this technology really implemented on the site or not? Which is to say that the IoTs are there or not, the sensors are there or not, they're providing us the data or not. These are validated by what I call a fourth party. So they go and check and confirm whether this is there or not. Now, the beauty of non-nature based projects is once you have verified the IoTs and APIs and sensors are in place, you start getting live data. And this data comes to a system which is called the net zero system. And then the system itself runs the data and relays it back to the buyer and seller. So data collection happens by us only. Data running also happens by us. We relay it back to the buyer and seller. And then on the system itself, we have fraudulent activity detection systems. So suppose somebody is over smart and they put two IoTs on the same EV machine. Now we know that the same EV is going the same velocity and same speed in the same time. And because our business model is charged on the transaction, not the project developer, everything culminates together when you stop the issuance of credit there and there. So the buyer has more confidence. Okay, the credit I am getting is really for the money I am putting. This is how the entire system works. Yeah.
Yeah, and it's possible for a credit for let's say a certain credit that you've issued or a validator has issued for the credit to either change from a certain grade to a certain grade given the deteriorations in the data that is being reported. Is that normal? Does it happen?
Unfortunately not, but for the credits that are not bought by the buyers, and then there is some fraudulent activity detected on the suppliers end, or the grade changes, like you have said, then those credits automatically either they are retired or expired or moved away from the system and fresh set of credits are generated. But these protocols are up to the standard and registries to define for themselves. Everybody has a different take over there. In our case, we support the buyer more, so we take out all the systems, all the credits from the system.
Um, And we also see the term, I think that you also use the term global south being used quite frequently when people talk about the carbon markets, and when we talk about how the global south tends to have predominance and also greater scope when it comes to accepting the model and propagating the model, right? Can you talk a lot more about what the global south represents in the carbon market?
Yeah. The definition of global south comes from the fact that these are all the developing or underdeveloped nations, the two words that are used, whereas the global north are nations that are fairly developed. Now, for a developing nation to become or an underdeveloped nation to become a developed nation, their energy requirements are going to increase because the population is increasing. You need more resources to generate more materialistic resources to reach a certain level of lifestyle and call yourself developed. That's the first principle thinking about it. Now, while this is happening, unfortunately, emissions will also increase. Now, how do you ensure the emissions don't increase? You move towards renewable energy, you move towards stuff like CCU and biochar, and you ensure that that emission is doesn't reach a certain number, which is also called net zero, equilibrium zero. You emit X number, you decarbonize X number, and you are zero. Now, for all of this to happen, money is required. Nothing happens without money. How do you get money? You do good work and you sell and generate those credits which can be bought by players in the global north who are already emitting beyond a certain number. That is why I say carbon credits is nothing but a means of sustainable finance. You get money for your projects. So this is one way to look at global south. The other way to look at global south is fortunately enough, our capex and opex of setting up these systems and running them is lower than the global north because of our price arbitrage or the labor requirements and the power generation over here. Now, if that is going to be lower, the cost of credit is also going to be lower. So it's a win-win game for the global north also to come and buy credits from here so that they get the money to run the projects. They get the credits and the system works efficiently until there is more supply and demand from the global south. And the third reason why we talk about global south is the entire narrative around conference of parties, COP, and whatever discussion that UN leads. It clearly says that the global north needs to support the global south. $300 billion is the number that is quoted in terms of sustainable finance, but nothing comes in. Whatever comes in is through the DFIs, and they are also now exiting India because of a growth story. So, who is going to support climate change in India? So, this is why this global south in three ways becomes so important to speak about.
Do you see this narrative changing anytime soon, right? Because um, the we are still to a lot of extent reliant on altruistic nature of companies and them wanting to put up the show of being truly global, and of course being truly driven by the need to reduce the carbon impact, the carbon effect, and being thought of as a stakeholder of the community, representing community, right? And we're solely dependent on that virtue, so to say. Do you see that nature like this model changing anytime soon with the voluntary carbon market coming to an end essentially, or being integrated with the entire cap and trade model that there
Yeah.
exists?
So, voluntary market can't be integrated with cap and trade because cap and trade is not run by projects. This is run by trading of emissions. Voluntary carbon market is still run by actual projects happening. That's number one. Number two, you have to look at it as pure play investments. If you were somebody running a corporation out of America and you had to park your money in a climate conscious project, you would look for the highest quality of the project rather than the geography of the project. Is geography not a problem for you? So when you talk about quality, now the question becomes, are Indian projects of that high quality or not? Because if they are, there is abundance of money available for these projects to capture and generate credits. Now, historically, and when I say historically, up till the last 36 months, there were question marks around the projects that were coming out of India because a lot of consulting activity was happening in Indian markets. The consultants will come and say, hey, I will get you carbon credit, that's at 70%, 50% of credit ours. We'll find you verifiers. The market was super corrupt. There was no structure to the structure market that we expected from Indian carbon market. In the last 36 months, what has happened is a lot of removal projects led by biochar we are seeing in India. So Varaha being one of the companies, they just raised 40 million last week. Alt Carbon, another company, and then a lot of companies that we have been talking to continuously beyond biochar, be it renewable energy, be it livestock methane, be it electric vehicles also. They are now taking carbon market seriously. They are taking the fact that pure good data needs to be relayed. And a body of knowledge called DMRV, Digital Monitoring, Reporting and Verification, which like AI, will call it a body of knowledge. DMRV is collection of data, reporting it, monitoring it continuously. This is further developed in India, which is giving buyers a lot more confidence, buyers of carbon credits a lot more confidence The projects originating out of India are not just greenwashing, but real projects. And again, this is where now the North, the global North, is looking at global South. And India and China are actually on the border of North and South. So these are two countries that call themselves developing. But the global North are now looking at India specifically to park their money and buy credits from us. So these are some signals from the market right now.
Are there any other countries that you notice, coming up with more and better projects? Of course, I think there are certain countries at top of our head we can all think of
Yeah,
as being ecologically gifted, right? To be called the hub of producers or
yeah.
project owners, right? Uh, Lesser industrialization compared to the other countries that we're looking at. How are they doing in terms of you know carbon markets? Are there more project developments happening there by either their own economies and the governments or by third parties?
So for sure there are. India is an example. I keep talking to my friends in Indonesia and Philippines, like they're blessed by the biodiversity over there, doing a lot of projects on what are called ARR or agroforestry, to call it. A lot of projects are coming out of now African continent, especially on biochar, on ARR, on saving the forest, which are called RED plus plus projects. They are picking up. So Rwanda, Nigeria, Kenya. These are some nations that we are speaking with right now. We onboarded a project in Nigeria, another one in the UK right now, and we are doing Australia, another country, doing fantastic work on carbon credits right now as we speak, generating and buying their own carbon credits. A lot of countries have what are called NDCs, nationally determined contribution goals. And for that also, there's a lot of debate that the country should generate credits within the country and use them for their NDCs. India is also debating whether India should be doing that or not. So, and that is why a lot of country level uptake on these we are seeing right now. China, we are getting a lot of signals because it's a closed economy. We don't get pure data on what really is happening. But China is another fantastic market, especially in terms of renewable energy as far as emission reductions are concerned. Yeah, yeah, these markets are picking up, and European Union, obviously, European Union has been the leader in showing the world how to reduce emissions by through these mechanisms, especially the EU cap and trade or the EU ETS, sorry, EU emission trading scheme, where they have reduced 45% of the industrial emissions in the last 20 years by organizing the cap that they put on the countries, on the companies. So yeah, pretty interesting moment in the market.
Right. Yeah. But what do you see as some of the tailwinds for the future in this sector? If somebody were to start within the entire ecosystem of carbon credits, which part of in the value chain do you think is the easiest to get into and let you see?
Yeah, yeah. So three, four things on this. Let's understand the value chain first. So one is a project developer, the second is standard registry, the third is the buyer of the credit. In the standard registry was an extension called a verifier. But then there are three more parties to this value chain that are at least not existing in India. One is a sustainable finance provider. Somebody has to provide sustainable finance for the project developers, for the projects to be there in the first place. And this need to be under what is called priority sector lending. So RBI 2 years ago, they came out with a gadget asking banks to provide loans to climate projects under priority sector lending, which is below 5%. Banks are today approaching us as saying, we can't spell climate change, how do we underwrite it? It's a fundamental problem for banks in India. So sustainable finance being one. Second is there is a vacuum for rating agencies to be present in the carbon credit space. Somebody has to rate the project. So there are some international companies that are serving the Indian market. No real Indian company doing that. And then there are no insurance providers for the carbon projects also. So this ecosystem, any of these three pieces, if somebody can take up today, there's a lot of work to be done. But the easiest way to enter the market is be a project developer. Do what you're really passionate about. It could be agroforestry, it could be solar, it could be biochar, it could be CCU, it could be direct air capture, it could be EV, it could be packaging, go on and on. That's the easiest way to enter the market. Most fun way to enter the market. You can build out companies very fast. Companies like us, which are verifiers, auditors, gatekeepers of the market, we are more of a horizontal play. So we work with multiple companies at the same time. That's another way to enter the market. Third way is be a broker for carbon credits, be an exchange, be a rating agency. Let the buyers know how the credits are working. So multiple entry points into the market right now. The market is evolving. The world generates 400 million credits in the voluntary carbon market every year. Anywhere from 13 to 17%. Different reports, they are different number, but 13 to 17% come just out of India. So India is a big market for this. We are sitting at about 4.2 billion as a market worth right now, and Morgan Stanley is calling it a 100 billion market by 2050. I say if even if not 100, it's at least going to be 50 billion market. Now the third point is why is it going to be 50 billion market? Because we have to decarbonize. There is about 60 gigatons of CO2 in the atmosphere that needs to be removed. Insetting is not going to help you do that always because, like I said, it's resource intensive. So at some point, carbon markets will be tapped into. So carbon markets will peak around 2045, 2050, and then slowly, once insetting or the rights law plays out, then they will stop coming down and become more insetting providers. Even for us at RenewCred as a company, our long-term goal is, hey, we don't want to exist just doing carbon credit. We want to support insetting projects later down the line. But we are a data player right now. We understand how the data will move and the data will come into picture later. So these are some tailwinds in the market. And finally, we have the net zero goals, CBAM, CSRD, BRSR, all the regulation tightening up. We have carbon neutrality talks. All of that is happening. So perfect time to enter the market.
Yeah, no, absolutely. And the vacuums that you've pointed out in the market are quite correct. That does describe the ecosystem, and then we see that as the wins for the future. We can fairly predict what might happen with the market if we look at it carefully, and if we juxtapose it to some of the other markets that we've seen and how they've grown. So I think it is the inflection point for the industry, if we were to put it like that. And yeah, thank you so much. I think that's all. Those are all the questions that I had. Thank you so much for doing this, Abhimanyu. I'm sure a lot of people will get a significantly better understanding of the market, and this really helps a lot of people. So thank you for that. Yeah, any
Thank
closing
you.
remarks, closing
No,
statements?
no, closing statement, just picking up what you said. While this is a beautiful market, it's a complex one to understand. And unfortunately, there's a lot of misinformation floating in the market right now, led by a lot of influencers also. One of the companies, their project was founded to generate credits and went to the Supreme Court. Everything was found to be hoax and a lot of influencers entered the market. So a lot of people who approach us and say, "Hey, I have a 100 square feet area. Can I put up a solar? Or I have 1 acre of land. Can I do agroforestry?" My request to them is please talk to people who either understand the market or collect more information, dig deeper, and then put your money or park your money into the market.
Hmm.
Because a lot of these early people, early stage B2C buyers, they might
Yeah.
end up losing money because smaller projects don't generate credits.
Hmm.
So you have to have a significant threshold also in the first place to generate carbon credits. That's
Yeah.
number one. And number two, whatever you do,
Hmm.
whether it be solar or biochar, understand the value chain completely. Who are you building for? Who are going to serve you? What is the carbon credit movement looking like? What is the price volatility? And then build out your cash flows. These are two learnings that I have for the market. Having said all of that, we need a lot of people who are really passionate about climate change, who really want to serve the not just the nation but serve international borders also and decide what the fate of the planet would be. So if there are people in the college or in school listening to this, please dig deeper into carbon markets. I'm more than happy to talk to anybody 24/7. Please reach out in whatever time zone you are, and yeah, let's go out and change the world.
Thank you so much, Abhimanyu. And if there are any resources from your end that you think I can attach with this episode so that people can either refer to those resources before making any decisions and get a better idea of the industry, because
Yeah,
people didn't want to rely on third party resources that are op-eds classified as information sources, right? So
understand.
yeah, so that'd be helpful.
I will share
Thank
with you. Yeah,
so,